So I want you to picture a boxing ring. The date is June 2026. The arena lights are glaring. And right in the center of the canvas, we have this clash of absolute titans.
Oh, yeah. It's quite the matchup right now.
It really is. Because in one corner, wearing the gold trunks, you have the legendary heavyweight, Bitcoin. I mean, the undisputed king of this space. The asset that basically launched the entire decentralized finance industry.
Right.
But if you look closely today, Bitcoin is taking some serious hits. It is up against the ropes, and it is looking visibly winded.
Visibly winded is a good way to put it, yeah.
And then in the other corner, you have the challenger that traditional finance just didn't see coming, which is stablecoins. And they aren't, throwing these flashy knockout punches.
No, not at all.
But they're absorbing every single blow the global market throws at them. They're standing perfectly steady and just quietly growing into an absolute behemoth.
We are genuinely witnessing a massive structural shift in how digital money actually functions on a global scale. And for you listening, understanding this specific matchup is crucial right now because the underlying market structure has, well, it's fundamentally transformed over the last 18 months.
Exactly. So, okay, let's unpack this. Our mission for this deep dive is to step right into the middle of that ring.
Let's do it.
We brought a really heavy stack of fresh sources today. We've got institutional reports from the Bank for International Settlements, the BIS, the European Central Bank, plus raw on-chain market data from DeFlama, and a few recent academic econometric papers.
It's a solid stack of research.
Right. And we're going to use all of this to unpack the fascinating divergence between Bitcoin's recent stumbles and the just unprecedented explosive boon of stablecoins.
Because the broader narrative has genuinely flipped, we really have to look past the daily price tickers and diagnose the actual plumbing of this shift.
Yeah, the mechanics of it.
Exactly. We will examine not just the market numbers, but the underlying mechanisms driving stablecoins to become the de facto internet dollar. And, more importantly, how you can strategically navigate what is rapidly becoming a highly hybridized financial reality.
Setting a clear baseline right out of the gate is really important here, because the data from June 2026 does not point to the death of Bitcoin.
Oh no, we've seen that headline recycled for over a decade.
Right, a million times. What the sources are actually mapping out is a story of maturation. The crypto ecosystem is segmenting into specialized roles.
Yes, exactly.
But to grasp why that evolution is happening, we have to look at the sheer scale of the numbers today. Because the data just rewrites the traditional crypto playbook entirely.
It really does. Let's look at the market cap, for instance.
Yeah, so the stablecoin market has just breached the $300 to $320 billion mark.
Which is staggering.
Right. I mean, there's a 50% expansion just since early 2025.
And the distribution of that capital tells an even more specific story about market demand. Tether, or USDT, is maintaining its dominance with roughly a 59% market share.
Wow. Still that high.
Yeah, it's primarily acting as the offshore liquidity engine. But circling right behind it is USDC from Circle, which is capturing this enormous wave of onshore institutional adoption.
Right, and driving significant on-chain volume growth along with it.
Exactly.
But the metric that really made me sit back and reevaluate everything was the annual transaction volume.
Oh, the volume numbers are insane.
They really are. Stablecoins are now processing somewhere between $27 and $34 trillion. That's a trillion with a T.
Trillion, yeah.
In certain market segments, that settlement volume is actually eclipsing traditional legacy giants like Visa and MasterCard combined.
Let that sink in. Visa and MasterCard combined.
Right. We're talking about networks that took half a century to build their global infrastructure. And this relatively new digital asset class is overtaking them in actual value transfer.
Because settlement volume is the ultimate indicator of utility. Trading volume just tells us people are speculating.
Right, just day trading.
Exactly. But settlement volume tells us people are actually using the network as a financial utility.
That makes total sense.
But the contrast is stark. While stablecoins are capturing that utility layer, Bitcoin is struggling to maintain its footing. It's hovering in the $60,000 to $70,000 range.
Which, to be fair, is historically high.
It is high.
Yeah.
But the weakness relative to the rest of the market structure is what really stands out right now.
Yeah, and the mechanics of that weakness are fascinating when you dig into the DeFlama data. Yeah. Bitcoin is suffering through these 15 to 20% weekly drawdowns.
Those are brutal drops.
So brutal. And let's unpack how that actually happens for everyone listening, because it's not just people suddenly deciding they hate the asset.
Right, it's a structural mechanism.
Exactly. When Bitcoin's price dips even slightly, traders who bought on leverage, meaning they borrowed money to amplify their upside, they suddenly face margin calls.
And if they don't have the cash to cover that dip,
Well, the exchange automatically liquidates their position. They just forcefully sell their Bitcoin on the open market.
which creates a vicious doom loop.
Exactly. The forced selling drops the price further, which triggers the next layer of liquidations, and that cascades into a 20% drawdown in a matter of days. Plus, we saw massive capital outflows from the spot EPFs, making this even worse in the first quarter of 2026.
And what's interesting is, during those specific volatility spikes, the data shows stablecoin market dominance jumping to 13% or higher.
Wow. So they run to safety.
Exactly.
Yeah.
Investors are executing a massive defensive rotation. They aren't cashing out to fiat bank accounts, though. They are rotating into stable digital assets.
They want to keep their capital on-chain, ready to deploy.
You got it.
So the real question here is whether this is just a temporary parking lot for nervous capital, or if investors are fundamentally changing how they interact with digital assets.
Well, the institutional reports heavily suggest the latter, and it's largely driven by macro dependency. Bitcoin is no longer operating in an isolated speculative tech bubble. It is completely tethered to the same global macroeconomic realities that drive traditional equity markets.
If we connect this to the bigger picture, how does that causality chain actually work?
So the sources explicitly map this out. Geopolitical tensions, particularly the ongoing U.S.-Iran dynamics we're seeing right now in 2026, they directly affect global energy markets.
Because energy prices spike.
Exactly. Spikes in energy prices feed into sticky, persistent inflation. And to combat that inflation, central banks are forced to maintain high interest rates.
And when interest rates are high, the cost of capital is high.
Right. So investors look at the risk-free rate they can get in, say, a government bond, and they decide that taking a risk on a highly volatile asset like Bitcoin just simply isn't worth the opportunity cost.
Yeah, capital naturally drains away from the risk curve.
Exactly.
And compounding that external macro pressure, it's the gravitational pull of the AI sector.
Oh, absolutely. The AI drain is huge.
Money that historically might have flowed into crypto as the premier speculative tech play is now being aggressively reallocated into artificial intelligence stocks.
But the pressure isn't solely external either.
No.
No, the on-chain data shows something equally concerning happening on the supply side internally. The ecosystem is seeing a structural shift in holding patterns.
You mean the long-term holders?
Yes.
The diamond hands?
Yes. The metrics tracking those long-term holders, the people who bought in years ago, they show them systematically taking profits and distributing their supply into the market.
Wow. So you have new supply hitting the order books at the exact moment. External macro pressures are choking off fresh capital inflows.
Precisely. That combination creates a very hard ceiling on price discovery.
You know, the sources used a brilliant analogy to clarify this shifting perception. They compared Bitcoin to a Ferrari.
I love that analogy. It's so accurate.
Right, because a Ferrari is an incredibly exciting, high-status asset. It's a masterpiece of engineering. It holds immense value, and keeping it in your garage is a massive store of wealth. But it is fundamentally impractical for daily life. You wouldn't drive a Ferrari to buy groceries.
No, it's loud. The maintenance is a nightmare.
Exactly. And you wouldn't risk leaving it in a crowded parking lot.
Yeah.
That is Bitcoin's current market position. It is the digital Ferrari.
The market has effectively settled that decade-long debate over whether Bitcoin is a peer-to-peer currency or digital gold.
It's gold.
Right. The narrative has solidified strictly around scarcity and value preservation. The volatility profiles we just discussed, those cascading leverage liquidations, make it entirely unsuitable to serve as a unit of account for everyday global commerce.
Right. So if Bitcoin is the Ferrari sitting under a tarp in your garage, you still need a vehicle to get to work every day.
You do.
You need a reliable Tesla. You need something efficient, predictable, and engineered for daily utility. And that perfectly explains the monumental capital rotation into stablecoins.
It does. And the institutional reports completely validate that daily utility. Stablecoins have evolved so far beyond their original purpose.
Yeah, these should just be safe havens for crypto traders.
Exactly. But today, they're facilitating cross-border global remittances at a fraction of the cost of traditional wire transfers.
Which is huge for the global south.
Massive. And they also serve as the foundational liquidity layer for the entire decentralized finance sector. They power all the automated lending and yield generation.
We are seeing integration at a scale that just seemed impossible a few years ago. I mean, Stripe, traditional banking consortiums, Visa, MasterCard, they are all building out technical rails to support stablecoin settlements natively.
It has moved from a niche crypto application to the actual plumbing of the internet economy.
But, that level of corporate adoption represents a massive philosophical pivot. Historically, this industry's primary value proposition was regulatory bypass.
Right, operating outside the banking system was the whole point.
Exactly. So if USDC is openly inviting audits and playing by traditional financial rules, aren't they just recreating a bank with extra steps?
Well, what's fascinating here is that tension is central to the current market dynamic. What the BIS and ECB reports highlight is that traditional corporate treasuries, we're talking the Fortune 500 companies, they cannot and will not operate in regulatory gray areas.
They just can't take the legal risk.
Right. A corporate treasurer cannot risk moving billions of dollars onto a blockchain if the SEC might arbitrarily classify those assets as unregistered securities the next morning.
That would be a disaster.
Legal certainty was the missing prerequisite for institutional adoption.
And the sources point to recent legislative milestones in the U.S. as the turning point, specifically the Genius Act and the Clarity Act.
Yeah.
And look, just to be clear to you listening, we're not taking any sides on the intense political debates surrounding those specific bills. We're just looking at this impartially. But from a purely objective market standpoint, those acts provided a defined legal framework.
Exactly. They established the rules of the road for digital asset classification and reserve requirements. And once that legal perimeter was established, institutional capital finally felt secure enough to enter.
And we really see the top stablecoin issuers navigating this perimeter differently, don't we?
We do. The research contrasts USDC's strategy of hypercompliance. Publishing detailed reserve audits, integrating deeply with established U.S. financial institutions against USDT's strategy.
Right. Tether is playing a different game.
Very different. Tether continues to dominate global offshore liquidity, particularly in emerging markets where dollar access is restricted. And they do this despite historical and ongoing debates regarding the exact composition and transparency of their reserve assets.
Yet both strategies are clearly thriving right now. They are just serving different market demands based on their respective approaches to regulatory friction.
Absolutely. And the real-world efficiency of this system isn't just theoretical anymore. The academic papers from the BIS feature econometric studies that apply really rigorous statistical modeling to this transaction data.
And what did those models find?
Well, they mathematically isolate and quantify the friction reduction. When you execute a cross-border payment through the traditional correspondent banking network, that transaction passes through multiple intermediary banks.
And every single one takes a cut.
Every single one extracts a fee. And they add settlement delays that can stretch across days. But the econometric models prove that stablecoins, under normal market conditions, just collapse that entire supply chain.
So smart contracts just settle the transfer instantly.
Instantly, drastically reducing excessive fees and offering incredibly low volatility compared to native crypto assets.
Reduced friction, zero intermediary delays, global reach. I mean, it sounds like the utopian financial system we were promised.
It does sound great on paper.
But here's where it gets really interesting. Whenever something in global finance is heavily marketed as stable or reliable, there is almost always an underlying risk being obscured.
Oh, absolutely.
And since we are dissecting this for a listener who wants the unvarnished reality, we have to look at the systemic vulnerabilities. Because stable absolutely does not mean risk-free.
Not even close.
We really need to examine what happens to a $300 billion shadow banking system when the market undergoes extreme stress. What happens when the engine lights start flashing?
The central bank reports actually spend significant time analyzing these exact stress tests. And the blunt reality is that a stablecoin is only as robust as the assets backing it.
And the infrastructure holding those assets.
Exactly. Systemic vulnerabilities and residual volatility are permanently baked into the model.
We're essentially talking about the mechanics of a digital bank run. And a great way to visualize a fiat-backed stablecoin reserve is to think of a coat check at a crowded venue.
Okay, I like this. Walk me through it.
So if 100 people hand over their coats, which represent their actual US dollars, to the attendant, they get a ticket in return. That ticket is the stablecoin. And as long as only a few people come to claim their coats at a time, the system works flawlessly. But what happens if a fire alarm goes off and all 100 people demand their coats at the exact same second?
Panic.
Total panic. And the system completely breaks if the venue only kept 80 coats behind the desk and lent out the other 20 coats to a storage facility down the street to earn a yield.
That is the exact mechanism of a liquidity crunch. If the stablecoin issuer's reserves are not held entirely in highly liquid short-term cash equivalents, they simply cannot meet simultaneous redemption requests,
Right. If those reserves are tied up in longer-term treasury bonds.
which may have lost market value due to the high interest rates we discussed earlier.
Exactly.
Then the issuer is forced to sell those bonds at a loss to honor the redemptions, and that can potentially render them entirely insolvent.
The sources reference the Silicon Valley bank crisis in 2023 as the prime example of this inherited traditional risk.
Oh, the SVB crisis is the perfect case study.
Yeah, USDC briefly lost its peg to the dollar. It dropped into the 80-cent range. Not because the blockchain failed, but because a portion of their cash reserves was held at SVB.
Right. When SVB experienced a traditional bank run, USDC's backing was momentarily frozen.
So by relying on traditional banks to hold the actual dollars, stablecoins essentially inherit every single vulnerability of the traditional banking sector.
They do. And the ECB report goes even further, contrasting that fiat-backed vulnerability with the catastrophic failure of algorithmic stablecoins. They specifically cite the Terra Luna collapse.
Oh, Terra Luna. That was brutal.
Because algorithmic stablecoins didn't use a coat check system at all. They relied on complex arbitrage incentives and reflexivity to maintain their peg.
Right, algorithms trying to balance the scales.
Exactly. And when market confidence evaporated, the algorithm entered a death spiral, destroying tens of billions of dollars in just days.
Wow. And beyond the immediate risk of bank runs, there are profound regulatory and structural headaches too. The papers detail massive gaps in AML and CFT, which are anti-money laundering and counterterrorism financing protocols.
Those gaps are a huge concern for regulators.
Because stablecoins move value across borders at the speed of the internet. So tracking illicit capital flows through decentralized mixers and unhosted wallets becomes an incredibly complex, sometimes impossible task for global law enforcement.
And this raises an important question, which is the ultimate concern outlined by the central banks: global contagion.
Contagion, yeah.
Given the scale of settlement we are talking about, trillions of dollars fully integrated with Stripe, Visa, and traditional banking infrastructure stablecoins are no longer contained within an isolated crypto sandbox.
They're part of the main grid now.
Exactly. If a Tier 1 stablecoin experiences a catastrophic failure today, it doesn't just wipe out crypto speculators. It could trigger a genuine financial contagion event, freezing global payment rails and threatening the liquidity of the traditional institutions integrated with them.
And the BIS paper explicitly mentions the threat to national monetary sovereignty, which is fascinating.
It's a very real threat.
If a private corporation controls the dominant digital currency utilized by a nation's citizens, the central bank of that nation effectively loses its ability to manage its own economy through monetary policy.
Because when citizens bypass the local currency and conduct their daily economic lives in dollar-denominated stablecoins, the local central bank cannot control inflation or stimulate growth by adjusting local interest rates.
The transmission mechanism of monetary policy is just completely severed.
Yes. If the digital plumbing breaks, the flood ruins the entire financial house, including the legacy institutions.
Wow. Okay, so we have analyzed the explosive growth data, the macroeconomic pressure suppressing Bitcoin, the undeniable daily utility of stablecoins, and the really profound systemic risks underlying the entire architecture.
We've covered a lot of ground.
We have. So how do we synthesize this? For you, the listener, trying to strategically navigate this space, what is the actionable framework drawn from this massive stack of research?
Well, the primary takeaway across both the institutional reports and the market data is that we are not looking at a zero-sum game here.
It's not one or the other.
No, the future is highly specialized and hybridized. The assets are settling into distinct complementary roles.
And the data projections make this really clear. Stablecoins are on a defined trajectory. They are expected to reach a $1 trillion market cap by late 2026 or 2027.
$1 trillion! It's wild!
They are cementing themselves as the undisputed global payment rails, the reliable daily driver for the internet economy.
But while stablecoins capture the utility layer, the macro models for Bitcoin remain remarkably
Yeah,
robust.
the sources agree on that.
The consensus is that once global regulatory frameworks are fully implemented and the macroeconomic cycle inevitably turns, meaning inflation cools and central banks eventually pivot to lowering interest rates, Bitcoin is projected to break its current ceiling.
Some models forecast a recovery pushing past the $150,000 mark.
Exactly.
And the really fascinating part is that the stablecoin boom actually fuels that potential Bitcoin recovery.
It does. It acts as a catalyst.
Right. All of that stable liquidity sloshing around the ecosystem acts as a massive frictionless on-ramp.
Because the moment macro risk appetite returns, that $1 trillion of stablecoin capital can flow instantly into Bitcoin without waiting for traditional bank wire clearances.
So the actual strategy derived from these sources is purposeful diversification.
Mm-hmm.
You hold Bitcoin for long-term value preservation, understanding its role as the volatile, high-status asset,
Mm-hmm.
and you utilize stablecoins for daily liquidity, rapid global transactions, and generating yield across decentralized protocols.
It really represents a profound maturation of the overall market structure. But, as we conclude our analysis of these institutional perspectives, there is a final concept worth dissecting.
Okay, let's hear it.
It builds directly on the central bank's warnings regarding monetary sovereignty and the integration of traditional finance.
The underlying philosophical shift. Lay the thought experiment out for us.
So we have spent this deep dive exploring how stablecoins are rapidly becoming the preferred, heavily regulated transaction layer for legacy giants like Stripe, traditional banks, and corporate treasury.
Right, they are becoming part of the system.
But if these digital assets are now fully compliant, heavily audited, and structurally intertwined with the existing financial establishment, are they still a revolutionary tool of decentralized finance?
Oh, wow.
Or have stablecoins simply become the ultimate Trojan horse, a beautifully efficient digital wrapper that is actually allowing the traditional banking system and sovereign regulators to quietly swallow the decentralized ecosystem from the inside out?
The ultimate Trojan horse. That completely upends the original narrative of crypto.
It does.
Are we actually building a decentralized, permissionless future, or has the industry just spent a decade building a faster, cheaper, more transparent ledger for Wall Street to operate on?
It's a tough question to answer.
That is a brilliant framework to end on. And as you ponder the implications of that Trojan horse, just keep in mind that the numbers and market dynamics we analyze today are a snapshot of the reality in June 2026.
Things move incredibly fast in this space.
They really do. This architecture is constantly shifting, so you must always continue your own research. Thank you so much for joining us for this deep dive. Keep questioning the consensus, keep your curiosity sharp, and we will catch you next time.